In the last section, we learned about the corporate structure behind the investment model and how the framework is built to support transparency, investor protection, and operational strength. Now we are going to understand the basic business structure behind GHL India Asset's property flipping model, how opportunities are sourced, how undervalued properties are identified, how value is strategically created, and how structured exits generate profitability. Because in professional real estate investing, profits are not created by chance, they are created through strategy, timing, and disciplined execution. Let's get into it. First question: how does your property flipping model work? At GHL India Asset, we follow a structured property flipping strategy focused on distressed and undervalued real estate assets across high-growth Tier 2 cities in South India. Our model is designed to create value through strategic acquisition, market timing, legal and operational enhancement, planned exit execution. Step-by-step process. Number 1. Identifying distressed opportunities. We source properties through our seller agent network where owners require urgent liquidity. Assets are undervalued relative to market potential. Number 2. Due diligence and valuation. Before acquisition, we conduct legal verification, encumbrance checks, master plan and zoning validation, government-aligned property valuation, pestle analysis. Number 3. Strategic acquisition. Properties are typically acquired at a significant discount to fair market value, allowing strong entry positioning. Number 4. Investor funding through SPV. A dedicated SPV raises capital through secured NCDs, asset-backed structure, trustee monitored security creation. The property is then acquired in the SPV's name. Number 5. Value creation and exit. We enhance value through market repositioning, structured buyer outreach, timing exits during favorable market phases. The final exit is typically through builders, developers, strategic buyers, and investors. We aim to make profit at the time of acquisition, not through speculation. We buy undervalued properties at strategic prices, structure them professionally, and exit at higher value through builders and buyers. We focus on cycle-based investing, entering during recovery and exiting during expansion. Our returns come from disciplined buying and structured exits, not market gambling. Second question: what types of properties do you invest in? At GHL India Asset, we primarily focus on distressed or undervalued residential and commercial real estate assets with strong resale and appreciation potential. Our investment selection is driven by market demand, exit visibility, legal clarity, value creation opportunity. Types of properties we target. Number 1. Residential land parcels. Plots in growth corridors. Layout approved or strategically positioned land. High demand from developers and end buyers. Number 2. Commercially viable assets. Properties in expanding business zones. Assets with strong future development potential. Number 3. Distressed properties. We focus on situations where owners need urgent liquidity. Assets are underpriced relative to market value. Market inefficiencies create buying opportunities. Geographic focus. Our focus is primarily on the Tier 2 cities in South India. These markets offer faster expansion potential, better entry pricing, strong transaction growth. What we avoid? We generally avoid highly speculative assets, legally unclear properties, low liquidity locations, overheated markets with limited upside. We don't invest in every property. We invest only where both downside protection and exit visibility exist. We focus on undervalued residential and commercial properties in fast-growing Tier 2 cities with strong resale potential. We prioritize liquidity and exit potential before return projections. Our strategy is selective, not speculative. Third question: why do you focus on Tier 2 cities? GHL India Asset focuses on Tier 2 cities because these markets are currently in the expansion phase of the real estate cycle, offering a combination of better entry pricing, faster growth potential, higher transaction velocity, stronger upside compared to saturated Tier 1 markets. Why Tier 2 markets create opportunity? Number 1. Early stage growth potential. Many Tier 2 cities are experiencing infrastructure expansion, urban migration, industrial and commercial development, increasing housing demand. This creates strong appreciation potential before peak pricing is reached. Number 2. Better acquisition opportunities. Compared to Tier 1 cities, assets are available at more attractive valuations. Distressed opportunities are easier to identify. Entry barriers are lower. This improves downside protection. Number 3. Higher return efficiency. In Tier 1 cities, capital requirement is significantly higher. Appreciation may be slower relative to acquisition cost, whereas Tier 2 cities can provide faster value realization, better spread between buy price and exit price. Number 4. Strong transaction activity. The locations that we choose will have rising demand, strong transaction velocity, attractive short-term price appreciation. These are critical for a property flipping model. GHL's strategic positioning. Entry during bottom or recovery phase. Exit during expansion or early downturn phase. This cycle-based approach works especially well in Tier 2 growth markets. We prefer emerging markets where growth potential is still ahead, not fully priced in. Tier 2 cities offer better entry prices, faster growth, and stronger upside compared to saturated Tier 1 markets. We target markets before institutional capital fully enters. We invest where the growth curve is still rising. Fourth question. Who buys the properties after redevelopment or value enhancement? After value enhancement and market positioning, the properties are typically sold to builders and developers, strategic land aggregators, commercial buyers, end investors seeking premium locations. GHL actively leverages a strong buyer agent network to identify and secure potential purchasers for each asset. How the exit process works. Number 1. Buyer network activation. Once a property is legally verified and positioned, it is marketed through GHL's network of buyer agents, real estate intermediaries, developers. With over 3,000 real estate business agents working with GHL as freelancers, we have a strong edge in buying and selling properties smoothly. Number 2. Targeting strategic buyers. The primary buyers are usually developers seeking expansion land, investors looking for verified assets, buyers entering growth corridors early. Number 3. Structured exit timing. GHL strategy focuses on acquiring during recovery phases, exiting during expansion phases. This improves sales velocity and pricing efficiency. Number 4. Earnest commitment from buyers. Purchase agreements are executed with the buyers. Earnest money is collected from buyers before final exit. This reduces exit uncertainty. We don't depend on random market buyers. We operate through a structured buyer network. Our exits are typically to builders, developers, and strategic buyers through a strong buyer agent network. Our focus is on liquidity visibility before acquisition itself. The strength of our property flipping model is not just buying well, it is exiting strategically. And the final fifth one. How do you generate profit from distressed assets? GHL India Asset generates profit by identifying undervalued or distressed real estate assets, acquiring them at strategic discounted prices, enhancing their marketability, and exiting at higher market-aligned valuations. The core value creation comes from buying below intrinsic market value, solving transaction inefficiencies, structuring professional exits. Where the opportunity comes from. Distressed assets often arise because owners need urgent liquidity. Legal or documentation issues delay marketability. Assets are poorly positioned or undermarketed. Sellers are unable to access organized buyer networks. How GHL creates value? Number 1. Strategic discounted acquisition. Properties are acquired at significant discounts, often around or above 30% below fair market value. This creates an immediate built-in margin. Number 2. Legal and structural enhancement. Before exit, encumbrances are resolved, documentation is verified, valuations are formalized, compliance clarity is established. This increases buyer confidence and asset liquidity. Number 3. Market repositioning. GHL leverages buyer agent network, strategic market timing, demand visibility in Tier 2 growth corridors. This improves resale potential. Number 4. Cycle-based exit. Our strategy focuses on buying during recovery or bottom phases, exiting during expansion phases. This maximizes the spread between entry and exit price. The profit is created at acquisition through disciplined buying, not through speculation. We create profit by buying undervalued properties strategically, resolving inefficiencies, and exiting through structured buyers at higher value. We focus on asymmetric opportunities where downside is protected by acquisition discount and upside comes from market normalization. Our edge is not luck, it is disciplined acquisition and structured execution. We hope this has given you a strong understanding of the basic level of GHL India Asset's business structure and how the property flipping model creates value through strategic acquisition, market positioning, and structured exits. In the next section, we will take things a step further and explore the intermediate level of the business model. You will learn how the team identifies hidden opportunities in the market, evaluates properties before acquisition, manages project timelines, handles multiple deals simultaneously, and adapts investment decisions based on changing market cycles. Because in professional real estate investing, finding a property is only the beginning. The real edge comes from how opportunities are analyzed, managed, and executed. Stay with us. The next level goes deeper into the operational intelligence behind the business.